Welcome to The Explainer. In this session, we're diving deep into a really key concept in property tax, how we figure out the annual value of a property. And to get our heads around it, we'll be using a hypothetical Section 21 from a future Income Tax Act 2025.
All right, let's kick things off with a question I'm sure many of you have thought about. Picture this, you own a house, it's been vacant the entire year, so you haven't earned a single rupee in rent. That means its taxable value is zero, right? Well, as we're about to find out, the answer is a little more complicated than you might think. Okay, let's get into it. The key to that question, and really the whole topic today, is this thing called annual value. You can think of it as the bedrock, the absolute foundation for how income from house property gets taxed. So, where does this all come from? Well, you've got to look at Section 20 of the Act. This section makes it very clear that the tax isn't just on the rent you pocket, but on the annual value of the property you own.
And this is where Section 21 comes into play. It defines annual value as the amount the property could reasonably be expected to fetch if it were rented out. Now, this is a crucial distinction. It's a deemed value, a notional income, and that right there is why a property with zero actual rent can still have a taxable value.
So, if it's not always about the actual rent collected, then how on earth do we calculate this value? Let's break down the formula for finding what's known as the gross annual value, or GAV for short.
It's actually pretty straightforward at its core. The gross annual value is simply the higher of two numbers, something called the expected rent and the actual rent that you either got or were supposed to get.
That immediately begs the question, doesn't it? We know what actual rent is, but what in the world is this expected rent?
Thankfully, the Act lays out a pretty clear three-step process for this. First, you take the municipal value and the fair rent, and you pick whichever one's higher. Then, you take that number and compare it to the standard rent. Your expected rent is the lower of those two. It's a smart system, really. It keeps the value tied to the market, but puts a legal cap on it.
Okay, so to make that formula work, we obviously need to know what these terms actually mean. Municipal value is pretty simple. It's what your local municipality says your property is worth for their tax records. Fair rent is the going rate, what a similar house in your neighborhood would rent for. And standard rent is the maximum rent you can legally charge under the Rent Control Act if one applies in your area.
Once you've got your gross annual value, there's one more step to get to what we call the net annual value, or NAV. You get to deduct the municipal taxes, but, and this is a big one, Section 21(3) has a very important condition. You can only deduct the taxes that were actually paid by you, the owner, during that specific tax year. Not just due, but paid.
All right, that's enough theory for now. Let's make this real. We're going to run the numbers for a property owned by someone named Rohan and see how this all works in practice.
So, here are the details for Rohan's property. We've got the municipal value at 2.4 lakhs, the fair or market rent at 3 lakhs, and a standard rent cap of 2.7 lakhs. He actually received 3.3 lakhs in rent and paid 24,000 in taxes. Let's plug these into our formula.
Okay, let's walk through this. Step 1. We find the expected rent. We take the higher of the municipal and fair rent, which is 3 lakhs. But then we have to compare that to the standard rent and take the lower amount. So our expected rent is 2.7 lakhs. Step 2, we find the gross annual value by comparing our expected rent to the actual rent. 3.3 lakhs is higher, so that's our GAV. Finally, we deduct the 24,000 in taxes he paid to arrive at the net annual value of 3,06,000. See? It's just a step-by-step process.
Now, you know with tax law, there are always exceptions to the rule, right? The standard calculation we just did doesn't fit every single situation. So let's look at a couple of important special cases. First up, and this is the one that affects most homeowners, is a self-occupied property. If you live in the house yourself, Section 21(6) gives you a huge break. The annual value is simply considered to be nil, zero. It's a major relief. But, and this is a big but, you can't just claim this for an unlimited number of houses. Section 21(7) puts a hard cap on it. This NIL value benefit is restricted to a maximum of 2 self-occupied properties. If you've got 3, you have to choose which 2 you want to apply this benefit to.
Okay, the second major exception is really for those of you in the real estate business, developers, builders, and so on. If you're holding a property as part of your inventory, your stock in trade, and it's just sitting there unrented, its annual value can also be treated as nil.
But again, there's a time limit on this benefit. It's not forever. Section 21(5) is very specific. You get this NIL value for a maximum of 2 years, and the clock starts ticking from the end of the financial year in which the property's completion certificate was issued.
Okay, so we've covered the law, we've walked through an example, but knowing the rules is only half the battle, isn't it? Applying them correctly is what really counts. So let's wrap up with the key things you need to remember for compliance.
Let's talk about some of the common slip-ups or practical issues we see all the time. Number 1. People trying to deduct municipal taxes that are due but haven't been paid. The law is crystal clear. It has to be on a payment basis. Another one is how to handle unrealized rent. Rent you just couldn't collect. Section 21(4) has specific rules for that. And finally, people often forget to cap the expected rent with the standard rent. It's an easy mistake to make, but it can be costly.
So what can you do to stay on the right side of things? Well, it really boils down to a few key precautions. First, documentation is your best friend. Keep every rent agreement, every tax receipt. Second, be meticulous with your disclosures in your tax return. And third, if you're lucky enough to own more than 2 houses, make a strategic and conscious choice about which 2 you're declaring as self-occupied.
All right, let's quickly recap the absolute essentials from today. Remember, annual value is a comparison, higher of expected rent and actual rent. Your expected rent calculation is always capped by the standard rent. Municipal taxes? You can only deduct them in the year you actually pay them. And finally, don't forget those big exceptions. Up to 2 self-occupied properties can have a nil annual value, and unsold inventory gets that same benefit for up to 2 years.
And there you have it, a deep dive into Section 21 and the determination of annual value. We really hope this breakdown makes things clear. Thanks so much for watching. Please do like, subscribe, and share this with anyone who might find it useful.
And just a quick final note, please remember, this explainer is for educational purposes only and isn't professional advice. Tax laws are always changing, so it's absolutely crucial to consult with your own professional advisor before making any decisions.